Let me record. Great. Now let me share the question. So we are revising August 2023 question 2B. Question 2B, the concept of NPV under capital budgeting. So the question reads like this. I hope you have your copy. So Tobin Limited is appraising an investment project which has a cost of 20 million shillings payable in full at the start of the first year of operation. The project life is expected to be 4 years. Project life is 4 years. Forecast sales, volumes, selling prices, variable costs, and fixed costs are as follows. So we have year 1, year 2, year 3, year 4, sales units per year, selling price per unit, variable cost per unit, annual fixed cost. Then we are given their additional information. Number 1, selling price and cost information are in current price terms before applying selling price inflation of 5% per year, variable cost inflation of 3.5% per year, and fixed cost inflation of 6% per year. Number 2, Tobin Limited pays annual corporation tax of 30%, with the tax liability being settled in the year in which it arises. Number 3, the company can claim tax allowable depreciation on the full initial investment of 20 million on a 25% straight line basis. So depreciation there is on straight line. Number 4, the company's investment project is expected to have 0 residual value at the end of 4 years. So no scrap value. Number 5, Tobin Limited has a nominal after-tax cost of capital of 12% and a real after-tax cost of capital of 8%. Number 6, the general rate of inflation is expected to be 3.7% per year for the foreseeable future. Required, the nominal net present value of Tobin Limited investment project, 8 marks for free. 8 marks for free. 8 marks for free. Let me stop the sharing now. 8 marks for free. 8 marks for free, guys. Here the examiner was wishing you guys, those who sat for this, a success. Very simple, NPV. So, after reading that question, guys, what should come to your mind is this: profit. Profit, abbreviated by this. We get this by taking selling price per unit. Selling price per unit minus variable cost per unit, minus variable cost per unit. What do we call this? We get this contribution. We call this contribution. Then when you multiply by quantity, you get total contribution. Then when you minus fixed cost, then you get your profit. So at the back of your mind, after reading this question, you must have remembered this. How to get profits. And then now, the other thing which now should come to your mind is, how do you change profit into cash flows? So when you say selling price minus variable cost, you multiply by quantity, you minus fixed cost. So I believe, guys, I gave you this. I reminded you about this. Lydia, I can see the space I am writing. is covered there. The place I am writing is covered. I can see it's covered there. I don't know. So that was just a reminder. This was just a reminder. This was just a reminder. So now let's solve that question. Let's solve that question together. Let's solve. It's a little blank. Let's solve this question together. Let's solve this question together now. Let's solve this question together. Let's solve this question together. Let's solve this question together. So first, let's do our workings here, because, sorry, I have written at the area you can't see. Oh, let me just do this. Let me just do that. So this is our workings. These are our workings. Just don't, yes. These are our workings. So let's start here with additional information number 1. I don't have the hard copy, but you guys will guide me. We have been told there is inflation. Guys, Leonard, we have been told, guys, we have been told, guys, there is inflation. There is inflation there. So that inflation will affect some variables. So let's compute the effect. Let's compute the effect of inflation, guys. So what will be affected is the selling. What will be affected, guys, there is what? The selling price per unit. I hope you can see there. So let's have our year here. We are told the project is for 4 years. We are told that the project is for 4 years. So let's have our year 1 here, year 2, year 3, year 4. Then let's start with the first one, selling price. Selling price. So can you guys give me the figures? Selling price for year 1. Selling price for year 1 is what? Halcano, selling price for year 1. Before now we do the inflation. Before we do the inflation. Can you give me, guys, the selling price? I don't have the hard copy here, guys. And I cannot always share. The screen. 125, year 2. Selling price year 2. Thank you, Cecilia Judith. 130. Year 3. Year 3 is 140, Grace. 140. Year 4. Year 4 is how much? 120. So I hope figures are in. These are in. Figures are in what? Figures are in what, guys? Are they in thousand or in million? I don't know. So can we oh, 𝐔𝐽, thank you. 𝐔𝐽. These are selling price per unit. They are shillings per unit, sorry. They are shillings per unit. This is selling price per unit. Let me write this. Per unit. Selling price per unit. Okay. Selling price per unit. Now, can we now get the effect of inflation? So we are told it will be inflated by what percentage? It will be inflated by what percentage? Selling price will be inflated by what percentage? By what percentage, guys? Selling price. Specific selling price. 5%. So can you give me the new selling price? Can you give me the new selling price for each year? Can you give me the new selling price for each year? Can you give me the new selling price for each year after inflated? After inflation. Can you give me the new selling price after inflation? Year 1, it will be 131.25. Year 2, sorry, year 2. We are answering which question, Jackie? August 2023, question 2B. 136 point 136 point 136. No. Guys, can you inflate this one? Can you inflate here too? It is 136.5. 136.5. 136.5 for year 2. Year 3. Year 3, we are getting 147. 5%. We are inflating by 5%. So we are inflating 140 by 5%. So 140, you take it as 100. You multiply by 5%. That will be 1.05. So it will be 147. Year 4, it is 126. Year 4 is 126. 126. Are we together? Are we together there? Are we together? Are we together? So this is how we get our new selling prices. This is how we get our new selling prices. You take 125, you multiply by 1.05. You increase by 5%. 130, you increase by 5%. 140, you increase by 5%. So these are our new selling prices per unit. Salesa, we are inflating. We are increasing. We have been given the selling prices per unit from the question. This is August 2023. August 2023. Question 2B. Question 2B. August 2023, question 2B. We have read the question. We have read the question, and I hope you are with us. So the selling price, which we have been given there, they are here. 125, 130, 140, 120. But we have been told in additional information number 1 that these prices will be affected by inflation. At what rate? At 5%. At 5%. So you need to take care of that inflation. So the effect of inflation will increase the selling prices. Will increase the selling prices. So this is how we got the new rates. So you will take 125, you multiply by 1.05. You multiply by 1.05. You take 130, you multiply by 1.05. You take 140, you multiply by 1.05. You take 120, you multiply by 1.05. 1.05, like that. So is that okay? Is that okay now? Are we together now? Are we together now there? Are we together? Are we together there? So I hope we are good. I hope we are good. So can we do the same for the other variables? Can we do the same for the other variables affected? So let's look at the sales volume. Sales volume. Let's look at the sales volume. Have they been affected? The sales volume. Have they been affected by inflation? Sales volume. Have they been affected from that additional information number 1? Sales volume. This is per year. Sales volume per year. Can you give me the sales volume, guys? Okay, they have not been affected, but please give them to me. Give me the figures so that only variable cost. Okay, it's okay. Can you give me the figures? Can you give me the figures? I put them down as a way of analyzing 300,000 for year 1. Year 2. Thank you. Year 2, 410,000. 410,000. Year 3. Sales volume 525,000. And year 4, and year 4, 520, 220. 220,000. Great. So what other variable have we been given there? We need now sales revenue. Sales revenue per year. Sales revenue per year. Sales revenue. Sales revenue per year. 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 Have we been given the sales revenue? Have we been given the sales revenue? Or we need to calculate that? Or we need to calculate that? Have we been given the sales revenue? Have we been given the sales revenue? No. So we have not been given the sales revenue there. We calculate. Thank you. Let's go to variable cost. Let's go to variable cost there. In fact, let me skip this. Let me skip this. Let me skip this. Or we can get the sales revenue. Selling price times. Great. I think we can get it here. We can get it here. But first, let's finish. Let's finish the other variables. Variable cost. Variable cost. Variable cost per unit. 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 Can you give me the variable cost per unit before inflation? 71 across. 71, 71, 71, 71. Let's finish the whole process. Let's finish the whole process, and then we will be computing now the revenues from using the new rates. Using the new rates. So after inflation, so we have been told the variable cost will be inflated by what percent? Will be inflated by what percent? Let's go systematic. Let's go systematic, guys. Will be inflated by 3.5%. 3.5%. So can you give me the inflation rate for this? For revenues. Can you give me the inflation rate for revenues? For revenues. Can you give me the inflation rate for revenues? Year 1, it will be what? Year 1, it will be 73.485. 73.485. 73.485. 73 across. So that will be across. 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 73. 73.485. 73.485. 3.5%. 73 point. Guys, are we correct? Are we correct? Why do we mean it is across? Why? Let me see here. Per year. When we are told that inflation is per year, guys, let me see. Let me confirm this. Times 125. What are we getting? 131. Then times 1.05. Per year, the figure is 71. The figure is 71. So the figure is 71 per year. Inflated. Yes, let's move slowly here. Let's move slowly so that we can see we are getting the right figures. So that we can see we are getting the right figure. Are we going to increase? Are we going to increase the new rate, or are we increasing the 71 for year 2, or are we increasing 73? That is what I am asking here. That is what I am asking. In fact, even for the selling price. In fact, even for the selling price. 125 times 1.05. That will be 131.25. 130 times 1.05. 136. No, let me see. 131.25 times 1.05. 137. We inflate. We need to understand here. We need to understand something here, guys. We need to understand something here. Are we inflating? Are we inflating from the one which has already been inflated? That is what I'm asking. Or we are inflating what we have been given here. 125, 130, 140. Let me see. It is inflated at 103, so we inflate 71 per annum each year, not cumulative. I think it's not cumulative. Second year, suppose we raise the inflation rate with the years for the particular year. We inflated years. 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 Just a minute. Figures are given throughout, and we can come up with our figures. Is fixed. Incremental in the sentence. No. About general, we are not there yet. We are not there. We are not there yet. We are not there. Let's deal with the additional information number one first. Let's understand additional information number one. Additional information number one. Let's work with that. Let's work with additional information number one first. Additional information number one. Additional information number one. Let's work with additional. We inflate the given figures. 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 We inflate the given figures times Alcano 1 point for year 2. For year 2, I got 143.25. 143. Selling price for year 2. Selling price for year 2. Selling price for year 2, you got 143.25. Raised to. Great. Great. I think, let me do this times 1.0. 6 raised to 1. Raised to 140. Just a minute. We need to understand here. Raised to 3. 162. Exactly. Now, variable costs are subject to change. Let's do together. Great. Now. Let's. is independent. Each year is independent. Exactly. Let's do this. Let's do this, guys. Let's do this. Each year is independent. Each year is independent. That is correct. Each year is independent. Each year is independent. Each year is independent. Each year is independent. Now, come here. So for the first one, I think here we are wrong. We are wrong. We are wrong. Can you increase 125 by 5%? For year one, I think it's correct. For year one, I think it's correct. 125 times 1.05. We are getting 131.25. 131.25. Can you do for year two? 130 times 1.05, raise it to 2. So here it is supposed to be 143. 143 143.33. I hope you are with me. 140 times 1.05, raise it to 3. So here it will be 162.07. Are we together? Are we together there, guys? Are you seeing what I'm doing? Then for year 4, it will be 120. You multiply by 1.05, you raise it to 4. So you will get 145. You will get 145.86. 145.86. So let's start from there. You do like this. You do like this times 1.05. Raise it to 1. You do like this, guys. For year one, you take 125, you multiply by 1.05. Remember, you assume the 125 is 100%. You assume the 125 is 100%. So you are increasing it by 1. You are increasing it by 5%. So it will be 1 or 5%. So you multiply by 1.5%. You multiply it by 1.5%. 1.5%. So you raise it to year 1. 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 Let me see if I can get a different approach. 131.25. Then you add it. No. You add it to... You raise it to 1. You raise it to 1 here. You raise it to 1. You raise it to 1. Why raise it? Kindly take me and make us understand. What we have been told here, guys, I'm getting confused. We have been told the selling price per unit, will be affected by inflation. Will be affected by inflation of what percent? 5%. 5%. Will be affected by inflation by 5%. 5%. So when you take 125 is equals to 100%. 100% for year 1. This is now, remember, this is year 1. Remember, these are years here. These are years. These are years. These are years. So 125%, you assume this one is 100%. 100%. So when you want now to increase, you raise it, raise. When you want to increase this one by 5%, so it will be 1 or 5%. You add the 5%. So it will be 1 or 5% of 125. Of 125. 125% of. So if 125 is 100, let's do this. If 1 of 125 is 100%. What about 1 or 5%? What about 1 or 5%? 1 or 5%? 1 or 5%? 1 or 5%? What about 1 or 5%? So it will be 131.25. 131.25. 131.25. 131.25. 131.25. So that is how we got this 131.25. But we were asking, are we raising the selling price given, or are we raising, are we inflating the inflated, which we have the new figure? Are we inflating 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 the new figure? This is the formula. This is the formula. This is how this is the formula which we have been used to get 1 plus r raise it to n to get the future value, to get the future value, to get the, this is what we, This is the formula which we are using here. This is the formula which we are using. This is the formula which we are using here, the raising here. This is what we are using here, guys, the raising. So you raise here according to the number of years. You raise it according to the number of years. That's why guys missed this. That's why guys missed this. Rather than inflation, rather than we will be getting a new rate. We will be getting a new rate, guys. We will be getting a new rate. We will be getting a new rate after inflation. So the present. So this like it's our present. This is our present figure. That's why I'm using the future. Are we together, guys? Don't guys. That's why I am using this formula. I am using this formula because the present figure is 125. That's why I am saying to get the new rate, So this is my present. This is my present price. To get my new rate, I will take 1 plus r, I raise it to n. I raise it to n. I raise it to n, guys. I raise it to n. I raise it to n. Just hear me out first. Just hear me out, and then if we have other simpler way, we will look at it. Is that okay? We will look at it, guys. If we have other simpler way, we will look at it. But this is what I was trying to explain to you. Is that correct? So if here I have 125, to get this 131, I will take now what? I want to get the future value. I will raise this one. I will multiply this by the 1 plus the 5%, then I raise it to year 1. Is that correct? Is that correct, guys? I raise it to year 1. Let me take you through this first. Then if there is other way, we shall look at it. We shall look at it. Is that okay? Is that okay? So I raise it to 1. I raise it to 1. So I will take 125. I multiply by 1.05. I raise it to 1. So can you use your calculator here? And I believe you'll get 131.25. Is that correct? Your future value? Yes. So now, so we are getting 131.25. We are getting 131.25. No. Can you take 125? This is Isabel. You multiply by 1.05. Then go to your calculator. That symbol here, raise it to 1. Finya hiyo, raise it to 1, year 1. You will get 131.25. You will get 131.25. Then Go ahead and get for year 2. Go ahead and get for year 2. Take 130 multiply by 1.05, raise it to 2. Raise it to 2. Raise it to 2. So take 130 multiply by 1.05, then finya raise above your sin kwa calculator yako. Above your sin, raise it to 2, not -2. Raise it to 2, year 2. Raise it to year 2. You will get 143.325. Then go to year 3. Go to year 3. Go to year 3. Go to year 3, and you will get these figures. Then can we do the same for year? Can we do the same for the variable cost? We cannot say the variable cost will be constant. No, because the number of years are different. We cannot say because variable cost per unit for year 1, 71, 71, 71, it will be equal also here. No, it will not be equal. It will not be equal. It will not be equal. So you will come here and say 71, you multiply by 1.035. You raise it to 1. So you will get 73. You will get 73. You will get 73 point what? 73. You will get what? Can someone give me the figure here? Can someone give me the figure for the variable cost? 73.49. 73.49. This is not hard. Some are saying it's complicated. Then 71 times 1.035. Raise it to 2 years. You will get 76.060606. Then come to year 3. 71, you multiply by 1.035, you raise it to 3 years. You get 78.72. Thank you. Then you come to year 4. You take 71 times 1.035. You raise it to 4 years. You raise it to 4 years. You get 81.47. 81.47. 81.47. 81.47. 81.47. 81.47. 81.47. Great. Can we now do for the fixed cost? Fixed cost per unit. You come here and say, my fixed cost per unit, fixed cost per unit, fixed cost per unit, fixed cost per unit. No, it's not complicated. It's not complicated. It's not complicated. I was just trying to find a simpler way, but no other way, no other way. No other way apart from getting this present value. It's like getting my future value. You use this formula. You use this formula. You use this formula. You use this formula. You use this formula here. So can we get the fixed cost? Can we get the fixed cost? Give me the figures. Give me the values here, guys. Give me the values. Give me the values. Fixed cost. Fixed cost. Fixed cost per year. Fixed cost, this is per year, what, 3,000, year 2, 3180, year 3, year 3, 3,200, year 4, year 4 is 3,000, year 2 is 3,1, 3,1, year 2 is 3,1, year 3, 3,2, 3,2, year 4 is 3,000. Can we get the inflation? Can we get the inflated? Inflated by what? 6%. Inflated by 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 6%. So what are we getting for here? It will be 3180. Year 2. year 2 is 3483.16.16. Year 3, that will be 32. You multiply by 1.06, you raise it to 3 years. 3811.25. 3811.25. And year 4 ni ngapi? 3787. 3787.43. So do we have any other? Do we have any other? Do we have any other? Do we have any other depreciation? Depreciation is on straight line. Can we get our depreciation? Can we get our depreciation? Can we get our depreciation so that when we do our final workings, we will be good to go. Let's do depreciation here. Depreciation on straight line basis. So depreciation will be constant. Depreciation here will be constant. Depreciation here will be constant. Depreciation will be constant. So who can give me the depreciation cost? Depreciation cost. Who can give me the depreciation cost? Straight line basis. Cost minus salvage value divided by number of useful life. So depreciation will be constant. It will be 5,000. Is that correct? Are we together here? 5,000, 5,000, 5,000, 5,000, 5,000, 5,000. Is that correct? Is that correct? All of us. Depreciation is 5,000. You take cost, you minus salvage value, you divide by number of useful life. I hope we are getting 5,000. So when you want to get the DTS, when you want to use the other formula, you take tax rate, you multiply by this. So what is our tax rate there for those who would wish to use the DTS way? For those who would wish to go to follow the DTS route, what is our DTS? Tax rate is 30%. Is it? Tax rate is 30% times 5,000. It will be 15. DTS will be 15, 15, 15, 15. So here we have everything now. We have everything. We have everything. We have everything. We have everything to get our new figures. To get our new figures. To get our new figures. We have everything to get our new figures. Great. To get our new figures. We have everything there to get our new figures. We have everything there to get our new figures. To get our new figures. We have everything. We have everything. Great, great, great. I think that is it. I think that is it. Can we now finish? Depreciation tax sheet. Note 2 says 25%. Yes, you can use Victoria, we know the formula. We know the formula of the straight line. But of course, when you take 25% of the cost, what are you getting? That is also another way. 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 But what you should know, Victoria, is that straight line method of depreciation is you take cost, you minus salvage value, you divide by number of useful life. You divide by number of useful life. But even if you take the 25% of the cost, you will get the 5,000. You will get the 5,000. You will get the 5,000. So are we good? Are we good now? Are we okay? Are we okay? Are we okay there? Are we okay? Are we good? Are we good? Are we good? Are we good? DTS, please. Okay. Depreciation tax shield. Check. Kemoi, depreciation tax shield. DTS, you take depreciation rate. You take depreciation, you multiply by tax rate. You multiply by tax rate. So are we together there? We have put everything here. It's like we have analyzed this. These are our workings. These are our workings. Naomi, these are our workings. Now it's upon us, or it's upon you, Naomi, to choose. Are you going to use the longer method, or are you going to use the depreciation tax shield route? It's upon you now to choose. It's upon you now to choose, but now you have simplified your work here. You have simplified your work. You have simplified your work here. So it's you now to choose. It's you now to choose which method to use. So can we now do that? Can we now do that? Which one do you want to use? The DTS or the longer method? DTS or the longer method? Which one do you want us to use? The DTS or the longer method? 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 Which one? Which one? Longer method. One that longer method. The longer method. Great. So DTS is time saving. So you guys, some are saying longer, some are saying DTS. So let's use that DTS. It's saving time. It's saving time. So you guys will give me the figures. I have grabbed here. You guys will give me the figures. 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 So let's have here our computation. Let's have our computation. So we'll have our year here. Let's have our year. Let's have our year. So this is year 1, year 2, year 3, and year 4. So sales revenue. So let's have our figures, guys, in 1,000. Let me put here figures in 1,000. Figures in 1,000. So we have smaller figures. Figures in 1,000. So the first thing there is to get our sales revenue. Sales revenue. Can you give me the sales revenue? Can you give me the sales revenue? Can you give me the sales revenue if they have been given? If they have not been given, we use what? We use what? We use the sales revenue. Can we get selling price, sales revenue? We take what? Selling price per unit. Selling price per unit, you multiply by what? Quantity. You multiply by quantity. Selling price times quantity. Is that correct? So can you give me the figure for year 1? For year 1. For year 1. 39,375. 39,375. 39,375. Year 2. Year 2, thank you. Year 2, selling price times sales volume. Yes. Year 2, 58,765. 58,765. 58,765. Point what? Yes, we are using the new rates. We are using the new rates, Isabel. They're inflated now. We are no longer using the original. No, we are using now the new rates. Yes, we are using the new rates. 765.3, 765.25, 25.25. Year 3, year 3, year 3, year 3, year 3. Let's get this first. Year 3, 850, 850, 86, 850, 86 point what? 0.75. And then year 4, what are we getting for year 4? 320.79.2. Then after getting the sales revenue, we need to less what? Variable cost. We need to less variable cost. Variable cost, variable cost, variable cost, variable cost. So who can give me the variable cost? Who can give me the variable cost? Remember, this is not per unit. We have been given variable cost per unit. To get now the total variable cost, you multiply by the volume, you multiply by the quantity. So year 4 is 323, year 4 is 320.89, like this, okay? 320.89, like that. Guys, year 2 is 58.765. This is okay. Year 2, 765 point. Yeah, 0.25, 0.3, that is okay. Any other correction here? I hope we are good. I hope we are good there. I hope we are correct. I hope we are good. So can you give me the variable cost for year 1? What is our variable cost for year 1? Let me see if you guys will. Variable cost for year 1. Variable cost for year 1? No, no, Grace. You need to give me the total. That is per unit, Grace. Whatever you are giving me is per unit. I want the total. You multiply by the volume. You multiply by the quantity. 220, 45.5. 220. Why people are getting different? Is it 220? Rounding off. 220.45. Even if you round off, I can see it will not come to 220.47. Let me see. 73.49. 73.49 multiplied by 300. Multiply by 300. So guys are getting 220.47, like that. We less. Can you give me for year 2? Can you give me for year 2? Can you give me for year 2? You guys have those figures there. You guys have the figures. You guys have the figures there. Why are you giving me now conflicting? Quantity. Mercy, you are saying no. So it's 45.5. 45.5. 45.5. 45.5. 45.5. People are getting 47. Where? 45.5, like that. Can you, what was our quantity? What was, let me see. Let me see here. Our variable, inflated, the new figures, our variable cost for year 1 was 73.49. 73.49. 73.49 multiplied by our volume, our sales volume. It was 300. So that was our figure, if I can remember, 73.49. We multiply by 300. So we are getting 22,047. 22,047. Unless you guys don't have that 73.49. 47. Like that. Oh, you used 73.485. Okay, that's where the problem is. Yes, yes. But there's no cause for alarm. There's no cause for alarm. 73.485, you multiply by 300, you are getting, yes, no problem, guys. If you will get your marks, you will get your marks. They are just a rounding off. But we can have uniform. We can have uniform. What I'm saying, for those who are getting 745, it's not wrong. It's only that you use 3 decimal places. Is that correct? You used 4 decimal places, 3 decimal places. So can you give me for year 2 then? Can you give me for year 2? Lucy, I think that is for year 2. 311. No. Jerry, it's because now we want to move together. But remember, you will be alone. So it will be now your speed. It will be now you against 311.6.6. Year 3 is 41,328. 41,328.8. There is no, it's exactly. It's exactly. You guys, we can work with the decimals now. We can work with the decimal, like 2, you can agree, you can like 2 or, point. Yeah, that will be okay. So 17,923. 41,359.5. 359.5. Then year 4, 17,923.4. 17,923.4. Let's get our contribution now. Let's get our contribution. Let's get our contribution. Let's get our contribution, guys. Let's increase our speed, guys. Let's at least 16. Mercy, you are getting 16,166 again. 17,329.5. 17,329.5. Year 2, what are we getting for year 2? 27,580. 27,580.7.65. Year 3. Year 4 is 14,165. 14,165.8. Year 3, I have not seen for year 3. 43. Year 3 is 43 what? 808. 758. What? 850, 86. Well, I'm getting different figures. 0.5. 43, 750. Cecilia is getting 43, 727. Well, 758.75. 758.75. We shall overcome. Great. So 758.75. Sawa. Let's our fixed cost now. Give me the fixed cost. Fixed cost. I hope you have the correct figures here. Please, they can repeat this. They can. I know that you will not miss. You will not miss an NPV. question. You will not miss. So let's be keen here. Let's get to understand. Let's get to understand it. So our fixed cost is what? 3180. Don't give me the old figures. Give me the new figures. The new figures we have calculated. The new figures after inflation. 141. Give me the exact figures. 3180. The next one, year 2. Year 2 now, what did we get? 3483. 3483. 3483 point what? 0.25. 0.16. Year 3, 3811. 3811.25. Year 4, 3787. 3787.43. Can you now minus? Can you minus and we get what? Can you minus and we get our what? Cash flow, not profit. Let's use profit before tax. Profit before tax. Profit before tax. Profit before tax. So what are you getting for here? 141.48. 14, 149. 14, 149.5. 14, 149.5. Year 2. No, Junior, we want to use the DTS. Junior, yours is for the longer. You can do that for the longer. Let's use the DTS to maliza hii swali. Let's use the DTS, Junior. Let's use the DTS. That's why nimetoa D hapa, nimetoa depreciation. Junior, nimetoa D hapa, ndio twende na ile other method. So can you give me for year 2 here? Can you give me for year 2? 24,097.54. Then year 3, 947, 947.5. 947.5. And then the last year, 10,378. 10,378.37. 0.37. Can we less tax? Less tax. 30%. Can you give me tax, guys? Can you give me tax? Can you give me tax for year 1? Tax for year 1? Tax for year 1. 30% of this, 30% of this, 30% of that. 4244, 4244.84. Year 2. Tax for year 2. Tax, year 4 tax is 3,113.51. What about year 2? 7229.26. Year 3, 11,984.25. Evelyn, are we using the fixed cost per unit or multiplying by sales? What are you asking, Evelyn? To get what? To get what? To get what, Evelyn? To get what? Are we using the fixed cost per unit? To get what, Evelyn? To get what, Evelyn? Fixed cost. Evelyn, fixed cost is per year. Evelyn, fixed cost is per year, not per unit. So we don't multiply. We don't multiply. If that is your question, Evelyn, if that is your question, we don't multiply by the volume. How did you get depreciation? No, it's not per unit, Evelyn. It's not per unit. Depreciation, UDA, we take cost. You minus salvage value. You divide by number of useful life. So what is the cost? What is the cost, UDA? It is 20 million. Cost is 20 million, UDA. So you take 20 million, which will be now 20 million, no scrap value, 20 million, scrap value is 0. Then you divide by 4. You divide by number of useful life. 20 million. Can you take that 20 million minus 0? Then you divide by 4. The project has 4 years. That is how we got 5,000. That is how we got 5,000. That is how we got 5,000. Remember, our figures are in thousand. Cut the 30. Can you cut the 3 zeros? Our figures we are reporting in thousand. That's why we are getting. Or you can take 25. You can take 25% of 20 million. What are you getting? You will get the same amount. Is that correct? Can you take 25% of 20 million? What are you getting? 25% of 20 million. 25% of 20 million. You will get the same figure. So are we together there? UDA, are we together? 5 million. So 5 million, remember what we are reporting here is in 1,000. So you divide this by 1,000. So you cut the 3 zeros and you will remain with the 5,000 we have used. You will remain with the 5,000 which we have been using. You will remain with the 5,000 which we have been using. So I hope you guys are understanding this question. Ndio ikirudiwa. A question like this, ikirudi, you get your how many marks? 8 marks or 12 marks, I don't know. So can we get now our profit after tax? Profit after tax part. uh-huh. 9904.65. Year two is 16. Oh, we shall help you, Mercy. We shall help you there. We shall help you there. Just let's finish here, and then we shall help you how to raise. We shall help you how to raise. We shall help you how to raise. Year two, 16. Let me see. 68.29. Year 3, 27. 963. 963.25. Then the last year 7264. 7264.86. Now, can you add DTS? Depreciation tax sheet. Add DTS there. 15. Add DTS of 15. Add DTS of 1515 so that we can get our cash flows. Add DTS there of 15. Add DTS of 15. Add DTS of 15. So year one, what are we getting as our cash flows? Our operating cash flows. Our cash flows per annum. We don't have terminal. We don't have terminal there. We don't have terminal cash flows. You will have added here terminal cash flow, scrap value. You will have added if there was working capital. But in this question, we don't have that. So whatever we are getting here will be our cash flows. So year one, let me get for year one first. Year two is 18. 18, 18, 18, 18, 368, 368.23. Year 3 is 29,463. 29,463 point what? 0.25. Year 4 is 8764. 8764 point what? 0.86. 0.86. Then year 1, it has missed, it has skipped me. Year 1 in ngapi, Esther? Can you guys give me for year 1? Can you guys give me for year 1? 11,404. 11,404.65. Great. So, can we now discount these cash flows? Can we now discount the cash flows? Can we now discount the cash flows, guys? Can we now discount the cash flows? Can we now discount the cash flows? So allow me to rub and then write them afresh. Can you allow me so that I can rub here and then I write them vertically. I write them vertically. What have we been given? 1,500, Nancy. 1,500 in DTS. Nancy, can you take depreciation, you multiply by tax rate? That is how we get depreciation tax shield. Depreciation tax shield, you take the depreciation amount, you multiply by tax rate. Thank you. Yes, if working capital was there, you would have added it here. Working capital, Isabel, is terminal. You can combine all the terminal cash flows. You can combine all the terminal cash flows, and you remember what are the variables? What are the components of terminal cash flows? You can combine them together to get the terminal cash flow, and then you add it here. Or you can add them separately. Salvage value, working capital, you can add them separately, like that. Yes, we are coming there. We are coming there, guys. We are coming there. We are coming there on the discounting rate. Just allow me to rub here. Just allow me to rub here, and then we are coming on the discounting rate. 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 Great. So come here. Let's have our years. Then let's have our cash flows here. So year 1, it is 11,404.65. Year 2, it is 18,368.23. Year 3, it is 29,403.25. And then year 4, it is 87,64.86. You guys will correct me here. You guys will correct me here. You guys will correct me here. Are these figures correct? And 29,463. 29,463. Thank you. Correct these figures here. 29,463. The rest are correct. 29, yes. The rest are correct. Yes, 4 is okay. Now listen to me. In finance, we discount using nominal. We discount using nominal rate. We discount using nominal rate. We don't use the general. We don't use the other rates. We use nominal. So here, the examiner was just confusing you. if you have the nominal rate, you are good to go. It's 12%. But how do you get the Fisher's formula? I taught you about Fisher's formula. Fisher's formula is 1 plus n is equals to 1 plus r, the real rate, into 1 plus the general. Are we together here? So here, we just use the nominal rate. But in case you have not been given the nominal rate, you have been given the general rate and the real rate, then how do you get the nominal rate? You use the Fisher's formula. So it will be 1 plus n is equals to 1 plus, what is our real rate? What is our real rate, guys? What is our real rate there? Our real rate, 8%, 0.08 into 1 plus. What is our general rate? Halkano, what is our general rate there? What is our general rate? 3.7. So 3.7, that is 0.037. Can you now get our nominal rate? It will be 1.08, you multiply by 1.037. So 1 plus n is equals to what? Can you multiply? 1.08 multiplied by 1.037. You will get what? 1.11996. So to get your nominal rate, you will take what? 1.11996 minus 1. So our nominal rate will be what? You minus 1 will be equals to 0.11996, which is equals to what? You multiply by 100, that will be 11.996, which is equals to 12%. So the 12% which you have been given there, you can get it through the Fisher's formula. But for this question, you guys should have just understood that we use nominal rate to discount. So you just come here and say PVIF 12%. PVIF 12%. So can you give me PVIF 12% year 1? Is it 0.8929? I don't know. Thank you. Year 2. 0. What? Year 2, 79.72. Year 3. Year 3. Year 3. $0.71. Year 4, 0.6355. Great. Can you give me now the present value? Give me the present value column. 2 decimal place. Let's be systematic. 2 decimal place. Give me 2 decimal place. Give me 2 decimal place, please. The present value. 10,183. 10,183.21. Thank you. Year 2. 14,463. 14,463.15. Year 3. 2971.94. Then year 4, $14,643. 643.15, 5570.07. Can you give me total present value? Total present value. Total present value, if we are correct. Total present value, if we are correct, it's 19. Total present value, if we are correct, 51,367.47. What is our nominal? What is our nominal? What is our nominal? What is our nominal rate there? What is our nominal rate? It is 12%. Our nominal rate is 12% there, Jackson. Our nominal rate is 12%. Can you look very well? Can you look at it very well? Our nominal there is 12%, not 8%. 8% is the real rate. 51,367.47. So can you less initial outlay? Can you less IO? Can you less IO? Initial outlay is what? How much? 20. 20,000. So can you get our NPV? What is our NPV? What is our NPV? What is our NPV? 31,368. 31,368.41 viable. And that is what was expected from you. That is what was expected from you. That is what was expected from you. 31,368.41 viable. Great. So I hope we are good. So let me show, let's help one of us there who has a difficult of getting raise. Guys, when you are given, these are variable costs. So you are given here, these are variable costs for year 1, year 2, year 3, year 4. Then you are told the variable cost is 71. Then you are told they are inflated by what percentage? Let's say by the 8%. Is it 8% or 6%? 8%. They are inflated by 8%. So here, what you do to get the inflation for year 1, you will take 71, you multiply by 1.08, you raise it to 1. 71 times 1.08, you raise it to 1. You come here, you take 71, you multiply by 1.08, you raise it to 2. You come here, you take 71, you multiply by 1.08, you raise it to 3. You raise it to 3. You come here, you take 71, you multiply by 1.08, you raise it to 4. Like that. So Mercy, Len, I hope that you have been helped here. So you just take 71, you multiply 1.08, you raise it to 1. I hope you know how to get the raising. So this will be 76.68. You come here again, you take 71, you multiply by 1.08, you raise it to 2. I hope you can see in your calculator, where is the raise button? Where is the raise button? It is an arrow like this. It is an arrow like this. It is an arrow like this. You just press this and then you write. If it is raised to 1, you write 1. If it is raised to 2, you write 2, like that. Like that, like that. Yes, Mercy, you can try. You can try by yourself. You have your calculator. You have your calculator, Mercy. You need just to do it by yourself to see if you are getting this figure. You just press. You just punch your calculator. 71. You multiply by 1.08. Then you punch that arrow thing. Then you write 1. And you confirm if you are getting this. Great. Yes, UDA, when we are discounting, we use negative. Future value, UDA. Future value to present value, we are minusing. Future value to present value is what we call discounting. And we will use 1 plus R, we raise it to negative N. But now, present value to future value. Present value to future value, UDA, we will now take 1 plus R, but N. N without negative. N without negative, UDA. This is now what we call future value to present value to future value. We call this one what? Compounding. That is the word. That is the word UDA, compounding. Compounding. That is the word I am looking at, compounding. There is discounting and there is compounding. Is that correct? So UDA, when you have been given when you have been given a present value, when you have a present value already, what this one, if you have a present value UDA, you will know what you are being asked here is the future value. It will be compounded because what you have is the present. For example, this is what you have now. For example, these figures from the question are the base, are what we have been given. Those are the present values. So when we are told to inflate them, we will be getting different values. We will be getting new values. We will be getting new values according to the years, according to the years. So I believe that is very much okay. I believe that is very much okay. I believe that is very much okay. There is a question of tracker company from the SCCA book. Do you guys have this SCCA book? Do you guys have this SCCA book? Tracker company. Tracker company. It is a question which deals with this. Tracker company. I don't know it is question page what? Guys, do you have the SCCA book? Do you have the SCCA book? There's a question there, tracker company. Let me see. Let me share with you. Let me share with you that question. Just 1 minute. Let me share with you that question. Tracker company. Let me share with you that. I have it in. Let me share with you. Tracker company. I hope I have it here. Let me share with you. Do I have it here? Tracker company. Do I have it here? Tracker. Great. Guys, what time do we still have time? Can we now go to the black scores? Let me do this. I will share with you that question. Let me try to find it. But it is in the SCCA book. And even Daktari did a video on this question. Did a video in the YouTube. I think it's in the YouTube. Capital budgeting. Ruth, capital budgeting. I want us to look at valuation. I want us to look at valuation. Imagine we have taken valuation of options. Valuation of options using black scores. Using black scores option pricing model. Black scores option pricing model. Black scores option pricing model. Black scores option pricing models. Black scores option pricing model. Black scores option pricing model. So what is an option? I want just to introduce this. It's just being introduced under capital budgeting, but it will be repeated in which topic? Risk, financial risk management. Topic 7, I think there's topic 6. Topic 6 or topic 7. So let's do this. Valuation of options using black scores option pricing model. So what is an option? So an option is a financial instrument. An option is a financial instrument. That gives the holder. That gives the right, but not an obligation. The right, but not an obligation to buy or sell. But not an obligation to buy or sell a specified quantity of a security at a predetermined rate or price. If you look at your course, if you look at our course outline, under capital budgeting, you can see there at the bottom there is what? There is options. There is options there. The real options in capital budgeting. Real options in capital budgeting. That is what we are looking at here. Real options in capital budgeting. So we have two types. Of options. We have two types of options here. There are two types of options. There are two types of options. Number one, we have the call option. And what does this call option say? It gives the holder to call. To call is to what? To buy. To call is to buy. To call is to buy. To call is to buy. So gives the holder, it gives the holder, the right, but not an obligation. The right, but not an obligation. The right, but not an obligation to buy a specified quantity, to buy a specified quantity of a security, at a predetermined price, at a predetermined price or rate. So this is what we call call option. Call option. That is what we call call option. Call option. Call option. That is what we mean by call option. Call option. Call option. Then we have now call option. The other one is put. Put option. The other one is put option. The other one is put option. So, Chepkemon, I hope you are through here. Are you through here so that I can wrap? And we look at the call option, put option, sorry, put option. We look at the put option. Uda, are you through? You are saying no. Are you through, Uda? Great. So let's look at the other type of option. The other type of option is put. So this put option, it gives, to put is to put something for sale. Call is buy. That is how you can remember these things. So it gives the holder the right, but not an obligation, to sell a specified quantity of a security at a predetermined price or rate. At a predetermined price or rate. So, what you need to know here also, under put option, under call option, they have been further categorized. They have been further categorized here into, they have been further categorized down. They have been further categorized down here. They have been further categorized down here. They have been further categorized down. So when we talk of call option, under call option, guys, we have option. We have option to expand. Then we have option to what? We have option to delay. Option to delay. Then under put option, we have option to abandon. We have option to abandon. And then we have option to do what? Option to what? To redeploy. Option to redeploy. So be careful here. Be careful here so that you can know, is this a put option or a call option? That is what now you need to be careful in a question. So listen here. When it's a call option, we know it has other two classifications. option to expand, option to expand. So as an investor, you have an option to expand that project. You have an option to expand that project. The option to delay, option to delay. Maybe the conditions are not favorable, so you are delaying that project. But at the end of the day, you will be able now to go ahead and implement that project. So it is still under call option. It is still under call option. Put option, option to abandon. You are abandoning that project completely. Maybe from the first evaluation you did, you found out that it was profitable, but you came to realize further it was not. You abandon it completely. Then you redeploy. You take resources from one source, you redeploy them to another project. That is what you need to know under options. That is what you need to know under options. Now, let's now talk about black squares. Let's now talk about squares. Let's talk about black 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 squares. Option pricing model. Let's talk about black squares option pricing model. So, sorry guys, what has happened? 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 Hey, what has happened? Great. So let's look at black squares. Let's look at black squares. Let's look at black squares. So black squares option. Pricing model. So black squares into bracket will be using what we call normal. We'll be using what we call normal probabilistic distribution. Normal probability distribution. Black squares option pricing model. Black squares option pricing model will be using the concept of normal probability distribution. Normal probabilistic distribution. Normal probabilistic distribution. Probability distribution. So black squares option uses the normal. This is the normal. This is what we call the normal probabilistic distribution. So this is what black squares uses exactly. This is what black squares uses. It assumes a normal. It assumes a normal, half, a normal. It assumes a normal distribution. It assumes a normal probability distribution. That is what it assumes, black squares. So under black squares, you need to know how to get D1. You need to know how to get D1, and then you need to know how to get D2. There are two very important steps here. So how do we get D1? How do we get D1 under black squares? You will take what? Napierian logarithm, ln into what? Into P over E. You close the bracket, plus into bracket, open another bracket. You take R plus what? Variance or standard deviation squared, you divide by 2. You close the bracket, you multiply by time in years. Then you divide by what? You divide by standard deviation, square root of time, square root of time, square root of time. I hope we are together here. Are you following? ln is natural logarithm. Natural logarithm. Natural logarithm, or we call this one Napierian. Napierian logarithm. Don't worry yourself, this one is in your calculator. ln is in your calculator. Then P is the spot price. Spot price. Spot price. P is spot price. P is the spot price. Then E is exercise price. E is exercise price. Sometimes they call this one strike price. You need to be very careful. Strike price. Exercise price or strike price. Then R is what? The required rate of return. Risk-free rate of return. Risk-free rate of return. Risk-free rate of return. Then T, this one is standard deviation. Standard deviation. Standard deviation. Then T is time in years, to be specific. Time in years. T is time in years. Are we together here up to this point? Are we together, guys? Are we together? Are we together? Time in years. You will be given in a month. CASNEB likes to give you guys this question in months. Time will be in months. So you need to change them into years. You need to change them into years. L is natural logarithm. Natural logarithm or Napierian. Napierian logarithm. It is in your calculator. It is in your calculator. It is in your calculator. It is given in your calculator. It is in your calculator. ln, Napierian logarithm. It is there. ln. ln is natural. Natural logarithm. Nimeandika hapa. I have written down. Natural logarithm or Napierian logarithm. Can you check your calculator? Can you check your calculator above tan? Above tan. Above tan. Above tan. Here. Above this tan. Above tan, there is in. It has been written as in. That is what we call ln. In. It has been written as in. It has been written as in. Spot price, Maggie, spot price is the current price today. Current price, current price. Spot price is the current price. That is spot. Spot is today. Spot is today. Spot is today. Spot is today. Exercise price or strike price is the exercisable. Is the price which you use, is the one which you use to purchase. Exercise. 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 The one now you use to purchase that financial asset. Are we together? Are we together there? Are we together now? Great. Now, can we use this question? Can we use this question so that you guys can? Then, sorry, let's how do we get D2? This is D1. This is D1. How do we get D2? How do we get D2? D2, you will take what? You will take what? D1 minus standard deviation, square root of time, square root of time. This is how we get D2. This is how we get D2. This is how we get D2. So I can see our time is not permitting us to look at this question. Can we pick it from there? Or are you guys, can we continue, or are you guys tired? Are you guys tired? Are you guys tired? Good night. Let's proceed. Continue. Good night. Tired. We continue next time. Let us speak from there. �𝐤𝐞𝐫𝐞. Okay. I can see majority are saying we have been in class from, tired. So let's pick it from there. Let's pick it from there. Okay. Let's consider others. Let's consider others. So let's continue from there. We will look at a question under black scores. We will look at questions under black scores so that we can wrap this up. We can wrap this up. No, we are almost there. Let me stop there. Let me stop the recording so that now we can